Good afternoon, ladies and gentlemen. We'll be starting in 10 minutes. Good afternoon. We'll be starting in about 6 minutes. And we're going to get started in just about 2 minutes. 2 minutes. Let everybody get on, get logged in. Just about 1 minute. Would you let me know in the Q&A, please, or the chat, if you can hear me? Please let me know if you can hear me in the chat or the Q&A. Great, thank you. Okay, we have a couple more people logging in. Let's just give it a few more seconds and we'll get started. Okay, people still coming on. Let's go ahead and start. Good evening, ladies and gentlemen, and welcome to the webinar. Tonight, we're going to talk about Social Security benefit options, how to potentially maximize your income. What do you need to know? What options do you have? My name is Jeff Woodard, and I'm a financial coach and a certified financial fiduciary. Tonight, I'm representing the National Association of Certified Financial Fiduciaries and AFIA. So AFIA is the American Financial Education Alliance, and I'll explain a little bit more about our mission shortly. But first, a few housekeeping details. So at the end of the workshop, we'll give you a workbook via email. Excuse me. My apologies, the pollen has been very strong today. We'll give you a workbook at the end. And if you have specific questions, we're going to ask you to please save them for your strategy session. So this workshop consists of 2 parts. Tonight is a 1-hour, fairly intense, a lot of information we're going to give you tonight. And we're going to ask you to go ahead and take notes. But again, we'll have a workbook at the end. And then when we have the strategy session, we can drill into your specific questions, your specific data, and answer any questions that you may have. Now, we are pre-scheduling these strategy sessions because my calendar is just chock-a-block. So at the end of the webinar tonight, within 24 hours, you'll get an email with a link for the strategy session and a time. Now, we can do this on Zoom or we can do it face to face in the office in Seneca, South Carolina, if you're close by, and I know some of you are. It's up to you, it's your preference. We'll give the schedule to you within 24 hours. We'll get the workbook to you, and then please let us know if this time works or we can reschedule it. So in the strategy session, we cover a number of things. One thing we'll do, of course, is run your specific Social Security numbers. So we'll look at your claiming options for you as a single or a couple and look for what optimizes your claiming strategy. And we'll also do an asset allocation report, which most people haven't given it a lot of thought probably, but the number one determinant of portfolio success has been proven time and again to be proper asset allocation. And that helps to reduce risk. And finally, we'll run a report called Retirement Ready or Not, where we answer those 4 questions. What rate of return do you need to get on your portfolio to be ready to retire and live to your life expectancy? How much money do you need to save, of course, to have your money last to the end of life expectancy? And how much longer might you have to work if you haven't saved enough money for your money to last? And we're looking at those fundamental questions and answers in the strategy session. So a little bit about AFIA. Our nonprofit mission is to inform and empower Americans to take control of their finances by providing comprehensive financial education in communities worldwide. We're funded by personal donations, tuition from advanced courses, which we teach at universities, chapter sponsorships, and membership dues. So if you want to make a tax-free, tax-deductible donation to AFIA, that will be in your workbook that you'll receive later. So we ask you to become a member. There's multiple financial tools and resources all in one convenient place, and it's free. 30 financial calculators, we'll do articles, videos. You'll be the first to know when we do these classes and university classes, and our chapter ID is 4744. You might make a note of that, and we'll happily sign you up. So here's the disclosure. And I'm not going to read it word for word, but I will hit the highlights. So the American Financial Education Alliance is recognized by the IRS as a 501c3 nonprofit organization that provides educational workshops and classes in businesses and universities nationwide. The instructors are trained and licensed financial professionals with a minimum of 5 years of real world experience in their field. Been required to pass a series of training sessions on how to properly educate in a not-for-profit setting before becoming a personal financial coach and instructor with AFIA. AFIA courses and workshops do not promote or endorse any specific products or companies, and no selling is allowed. AFIA educational workshops and courses are general education only, not intended to be construed as investment, tax, legal, or financial advice. Attendees should seek the assistance of a professional familiar with the course prior to implementing any of the ideas and strategies taught or discussed. Hypothetical and historical returns are informational purposes only and are not an offer, solicitation, or recommendation. Rates of return are not guaranteed, and for illustration only, projected rates do not reflect actual expected performance, and past performance does not guarantee future results. Not tax or legal advice. The instructor can provide information, but not advice. The fundamental difference, so guidance can come from the Social Security Administration. The presenter may be able to identify potential retirement income gaps and may introduce products as a potential solution. Social Security benefit payout rates can and will change at the discretion of the SSA. So with that out of the way, let's introduce Owlie. Owlie will be assisting and will pop up from time to time as we go through the course to trigger a thought, maybe trigger a question for you, or to keep you on track. Many of the slides will have the workbook page number in the upper right-hand corner. Take notes and also expect to see your book at the end of the class. So let's get started. The question is, what is Social Security to the average earner? Well, according to the Social Security Administration website, Social Security benefits are meant to provide 40% of retirees' income. So what that means, in effect, is 60% of that income must come from other sources like retirement plan distributions, annuities, brokerage accounts, IRAs, 401ks, and other savings. And maybe you remember the three-legged stool, the famous three-legged stool, which was Social Security, a defined benefit pension plan, and savings. Well, that stool is a bit shaky, and we'll talk quite a bit about social today, of course, but defined benefit pension plans have pretty much gone the way of the dodo bird. Less than 10% of private companies in this country today offer defined benefit traditional pension plans. So we have to be very cognizant of retirement income planning is more than Social Security. It's how does Social Security fit into the overall picture? And that's what we focus on. So how complex is it? Well, there's multiple claiming strategies, 81 age combinations, and more than 567 different sets of calculations to consider. And if you make a mistake, it could cost well over $100,000 during your lifetime. Well, I don't know about you. I like numbers. I really enjoy running numbers and doing this kind of work, but I don't want to run 567 different sets of calculations every time I sit down with a couple. And of course, that's why we use the software that we'll use in your strategy session and help you to determine what is the best strategy for you. So here's the famous question we get all the time. Will it be there? Well, I can remember when I was in my 30s, we asked the same question. So let's look at what the Social Security admin is saying. Now, I doubt that many of you have read your statement in detail, but here's what's written on the 2009. Notice a few relevant numbers. In 2017, we'll begin paying more than we collect. Without changes, by 2041, it'll be exhausted and we'll only pay 76 cents. Okay, so 2017, 2041, and 76. Then we drop to 2016, and then we move down to 2037, in other words, 4 years different, and we're at 76 cents. Now in 2014, that number dropped again for 4 years by 2033, and there'll only be enough to pay 77 cents for each dollar. Now, we laugh about that because we say, why did it go up to 77 cents? Well, we think maybe because they quit giving you these statements in the post and maybe they saved a penny. We don't really know, but you may have received these in the post. Some people still do, and we'll talk about that a little bit more. Now, in 2020, those numbers are 2033 or so, but of course, with COVID, things may well have changed and they went to 75%. So the real question is, will it be there for you? Well, I like to make a statement here about how do we plan, because in age categories of people who are getting ready to retire, we certainly want to plan for social to be there. Now, we may want to knock it down by, say, 25% in 10 years or so as part of our overall plan, and that's a viable strategy. But the main thing is to know is what will happen in 30 years or more? Life. Life will happen over the time that we're projecting. So the best we can do is plan for what's in front of us today and make decisions based on facts and data today to position yourself as best you can. Okay, so there's one of my favorite quotes from Dwight David Eisenhower, where he said, in planning for battle, I have always found that plans are useless, but planning is indispensable. Now think about that for a minute. Plans are useless, but planning is indispensable. It's the planning that does the work. So when you get into battle, when you get into life, after you leave the seminar a year from now, things will change. But the fact that you planned means that you're much better able to adjust to the changing tides and the changing winds that we see right now all around us. So let me give you an example. Let's say that you need long-term care. Now, I say the quickest way to clear out a cocktail party is to talk about long-term care. Very few people want to talk about it, but I'll ask the question, and I can't get a lot of feedback tonight on the webinar, but ask yourself, do you have homeowners insurance? And I'm sure if we were in a live seminar, everyone would raise their hand. Of course you do. What are the odds of your house burning down in the next 10 years? Or even making a substantial claim on your insurance? Less than 1%. Car insurance? Sure. Everybody has car insurance, it's required. And what are the chances that you're going to have a major wreck or need to use that insurance in the next 10 years? It's only about 8%, depending on your age and how much you drive. Long-term care. According to a number of studies, 70% of Americans will require long-term care at some point in their life. It may just be a very short time, but 70% will require long-term care. Now, again, I can't see you raise your hand, but how many on this webinar have long-term care? In the US, in the retiring age cohort, 55 to 70, it's only about 30%, but there's 70% need. Now, what if you do need long-term care? About $90,000 a year, that's what you can plan on. So if that's an unexpected expense, and you need it for 3 years, that's not 3 nines is $270,000. Because if you're drawing that money from a pre-tax account, from a tax delayed account, like a 401k or an IRA or an SEP, you've got to pay taxes on that when you take it out. So that $90,000 is more like 115. So that becomes $350,000 or so. That could put a pretty big dent in a lot of people's retirement plan. So we want to be aware of these things as we plan. Now, lighten it up a little bit. Who is that? Have you seen this picture? This is Ida Mae Fuller. Ida Mae paid in $22.54 to Social Security, and she received $22,888. She lived to be 100 years old. So she got a pretty good deal. Now, remember, for you, it's a different situation, of course. And now the demographics have changed dramatically, because at the age of 1913, when Social Security came into being, it was considered longevity insurance. Essentially, the average age longevity was 62 years. So they started at 65, and they didn't think they'd have to pay much, except for those few lucky people like Ida Mae. Now the question is really, will it be enough? And remember, it's only 40%. So you have to answer the question, what other income sources will you have after you retire? And you really want to work this with your spouse, because there's spousal benefits. It works together. We're going to talk about that on the webinar tonight. Now, guaranteed income is what we want to talk about. And I asked the question, again, I can't see your hands, will taxes go up or down in the future? What do you think? Taxes up or down in the future? Well, nobody I've met in 5 years has said taxes are going to go down in the future. All you got to do is pick up the newspaper today. So over half of Americans claim their Social Security benefits at 62, and that leaves significant and permanent effects. So the question people ask is, will there be enough? Will I outlive my money? 54% of Americans are worried about not being able to maintain their current standard of living in retirement. So people are saying, I'm worried about not being able to maintain. I'm worried if I'll have enough. But 95% of my clients have their money in a tax postponed, tax deferred account, like a 401k or an IRA. So there's a fundamental disconnect here. So we need to be thinking about taxes very seriously today. Now, you might remember those ING commercials, date myself a little bit. What's your number? They were at the bank or the grocery store, your number, there was 1.2 million or whatever float around. And I really think that's a disservice, because we all think we have a number, but you live on income, not on assets. And so think about, how do you turn your assets into income? And the fact is that we have a low tax window today. So you can think about a strategy to rearrange at least some of your assets into tax-free retirement. So the main thing is, how much do you really have? So when you look at your statement from Merrill Lynch or Schwab or whoever, you might be happy. You say, I've got $1 million. Do you really have $1 million? No, you really have more like 700,000, 750,000 bucks today. And what are we going to have tomorrow? We don't know. Because remember, qualified plans like IRAs, 401ks, they postpone the tax and the tax calculation. Okay, again, think about that. They postpone the tax. Yes, that's why we did it, because we want that tax deduction going in. We want to save money, and the tax calculation. Now, we all got that story. I got it, you got it, I'm sure. You'll be in a lower tax bracket when you retire, when you take the money out. Well, that might have been true in the 80s and 90s, but that's not true today. Today, we see taxes going up. We see people, that's wild spending in Washington, D.C., out of control government. We see deductions potentially coming down. There's a number of red flags in front of us that really show taxes are not coming down. We may well not be in a lower tax bracket in retirement, and we'd better be ready for that. So the main thing is to position yourself. I'll let you read that. You want to control your money. So control is a word that we'll come back to. Do you want to control your money, or do you want to let the government control your retirement? And again, Social Security is just one piece of the puzzle. What are the pieces of the social puzzle? Well, what will the benefit be? What options are available? And how can you maximize your lifetime benefit? Your Social Security statement is fundamental information that you need to find. So I'm going to ask you one homework right now. Before you come to the strategy session, make sure you have your numbers, okay? Your Social Security benefit numbers are very important, really useful information. If you don't get it from the Social Security mailed to you, you can sign on and get it. Now, you'll get the primary insurance amount that Allie's talking about. That's the amount upon which all your benefits are based. It's based on the highest 35 years. And if you have 40 credits, so if you have 10 years, 40 credits, 40 quarters, then you'll be eligible for Social Security. So another thing to think about, if you have zeros averaged in, like you were overseas, or mothers who were not working in the workforce, the longer you work, you average numbers in there instead of zeros going forward. So good information to be aware of. So set up the account online. It's very straightforward. SSA.gov, my account. You'll review your benefits. You can update your address. That's homework for everybody. Now, where we headed? Eligible, weapon GPO, COLAs, claiming age, working, taxation of benefits. There's a lot to this puzzle. Okay, so we're going, that's a little bit of an agenda. A couple of definitions. Eligible worker has accumulated the maximum number and is 62, and entitled has applied whether they're receiving them or not. So just definitions. Those who worked in government will be interested in WEP and GPO. We won't drill into it much in the webinar, but certainly we can do that more in your one-on-one session. So what about COLAs, cost of living adjustments? Well, that provides inflation protection by helping maintain the purchasing power. So COLAs are listed here. It's coming from the CPI price index from the previous year and 1 year back. Now I'll let you look at that and you tell me if you see a trend. So it's been 3.6, and we know inflation has been relatively benign, although I'm becoming extremely concerned about inflation, and I know a lot of people are. But you can see that 1 to 2% is pretty much where we should probably plan. You see there's a zero in there. Allie says use 2%. I usually use about 1% just to be conservative. Okay, so the claiming age, this is important, and the retirement age is not 65. Okay, so the earliest age you can claim is 62. Full retirement is 66 from 43 to 59, but after that, it goes up by the month depending on your age. Okay, this will be in your workbook. It'll be crystal clear in there. The latest age you can claim is age 70. So what about waiting? Okay, so obviously the pros of taking it now at 62, which 50% of Americans do, you get the smallest monthly check, and I'll give you some numbers. And you get reduction if employed. We'll talk about that. Full retirement age, you get a higher monthly check, no penalty if employed, but no benefits, obviously, to FRA. 70 is the highest check, no penalty if employed. Of course, you have 8 years with no benefits. Now, there will be questions again in your workbook. You might want to jot this down as a memory. By what percentage are your benefits reduced if your FRA is 66 and you claim at 62? I'll let you noodle on that just a second while I get a drink of water. Well, the number is about 25%, and I'll show it to you. If you wait until FRA, you receive 100% of your benefits. If you wait till 70, this is an interesting number, you'll get 8% increase per year for those years from 66 plus to 70. So those 3 to 4 years, you'll get essentially guaranteed 8% increase per year, inflation adjusted. Now, that's a pretty good deal when you think that there's not even an annuity you can buy that does that. Okay, so that beats any annuity you can buy because it's inflation adjusted before you get it. So the general advice is to wait until 70, but there's a lot of reasons not to wait as well. Okay, because bad health, you need the money. There's a lot of reasons not to wait. It's a personal decision, but look at this chart. Okay, so let's assume at 66 and 4 months, your FRA is $1,300. So what does it look like if you take it early? $953 is a big difference from $1,300. Okay, so it's about 25% drop. But if you wait, look what happens, $1,681. So $953 versus $1,681 is a monthly benefit difference of 76% for the rest of your life. Okay, and remember, it's inflation adjusted. And remember, it affects your spousal benefits and your survivor benefits for your family. So very important decision. My typical advice on claiming is this: make a decision based on your family history, your needs, in conjunction with your other retirement assets, but make a decision based on data and facts, and not innuendo that it's going to go away next week or that I'm going to die at 66. All of those might be valid, but think about my comments about what we plan for. We plan for what we know. And right now, this is as good as we can do. Okay, so some important definitions. Deemed filing, any benefit before their FRA must have all. Restricted applications, we're going to talk about that, and suspension, we'll talk about that as well. So, big question. When should you start taking? Well, my analogy here is the horses. So you remember the Westerns where the cowboy had a long ride ahead of him and he was going to go across the desert. So he took 2 horses right as he left. So he took the white horse and the black horse. Now the smart cowboy would ride one horse, and then when he got tired, he'd switch, put the saddlebags on the other horse, ride that one, let the other one rest a while, and then switch again. Now, some cowboys rode one until it was exhausted and died or broke a leg, and then would ride the other, hoping he would get there. I don't know about you, but I think the first strategy makes a little bit more sense, where in our analogy, one horse is your assets and the other horse is your Social Security. So again, there's a lot of reasons to wait. There's a lot of reasons not to wait. But if you wait, and you're retired, you need to have a spin down strategy where you use your assets until it gets you to your Social Security when you need it. Then remember the tax consequences. Okay, so you need to work with an advisor who understands the facts of how the taxes will play into all of this. And we're going to talk about Social Security taxation tonight. You must have some of your assets in a tax-free bucket as much as you can. And again, that's something we'll talk about in the strategy session. Now, how will working impact your benefits? So from 62 to FRA, there's a limit of 18,960, and for every 2 over the limit, $1 is withheld. When you get to FRA, it's 50,520, and $1 is withheld every 3. After FRA, there's no limit. So let's me ask before we move on, who knows what this definition is of provisional income? So I'm going to just pause a second and say, do you know what provisional income is? Because it's a very important number. So provisional income is the sum of all your income, including, quote, tax-free municipal bonds, unquote, plus half of your social. So common sources include social, half of social, wages, distributions from your traditional plans, interest income, rents, pension payments, inheritance. Okay, so all of those affect social provisional income, but why is that important? Well, do you know how your benefits will be taxed? Are you aware of the Social Security tax torpedo? Well, this is an illustration. This is exactly how your Social Security benefits are going to be taxed. So for married, filing joint under 32,000, there's no tax on your Social Security. From 32 to 44, it's up to 50%, and over 44, it goes to 85%. Now, this is the tax torpedo. So if you, for example, are married, filing joint, and you're in the 25% bracket, when you jump from 32 to $32,001, that incremental dollar is taxed 50%. That's a 37.5% effective tax rate. And if you jump to the 85% on that marginal dollar, that's a 46% tax on that marginal dollar. I can tell you, most people have no idea that this is waiting for them down the line when they're not having income and all of a sudden they're being taxed this way. Now, Ali's going to point something out that's really important. These tables haven't changed since 1985. Now, what happens if a couple needs $40,000 to maintain their standard of living and one of them dies? The cost of living is not going to go down that much. Still needs about 40 to maintain a surviving spouse's lifestyle. What happens to their taxes? Well, they lose one check, right? So usually it's a she because women live longer. So usually in our generation, the men made more money. So the man, maybe he was getting 2,000 and maybe she's getting 1,000. Okay, so he goes away, he goes to heaven. Now she gets 1,000. She took a 33% cut in her social, but what happened to her taxes? Well, she went from a 50% tax rate to single filing. Now she has a double whammy, and now she's moving to an 85% tax bracket on her Social Security. So we call that a double whammy. Now, again, this can be minimized with proper tax planning. So we'll talk about that when you come in or do the Zoom for your strategy session coming up. So how do you reduce or eliminate tax? Well, you cut this back. You reduce these sources of income that get calculated into provisional income. Okay, and we're going to talk a little bit more about that, but now our agenda coming up next, I'm going to keep it moving fast because I know on the webinar, it's hard to maintain your focus. You probably do it. Don't do Facebook, please. Stay with us. There's some pretty good stuff coming up here. Spousal benefit, file and restrict, do over reset, start, stop, reset. Okay, and we'll look at these specifically in your strategy session if you have specific questions, but I'm going to cover them fairly quickly now, just so you're aware. The spousal benefit is huge. In order to claim a spousal, you must be at least 62 or have a qualifying child, been married at least 1 year, okay? So that's how you claim spousal. If you elect to receive it before you reach FRA, your benefit will be permanently reduced and you will not be able to switch later. So be aware, there's some potential mines here in the path. So again, we're going to repeat, to start your own benefit early and switch when you receive, you will not receive the full amount. Your own benefit was reduced because you elected before FRA, and it would be less than 50% of your spouse's benefit. Now, Ali's telling us about the Bipartisan Budget Act of 2015, which came into effect in October of that year. Big changes, a lot of reductions, a lot of kind of loopholes were minimized or cut. File and suspend was gone. File and restrict is still there, but we will discuss that briefly. And there's a lot of detail on it on page 21 in your workbook, which you'll get. If you stick around to the end, we'll get you that workbook with all this information in it. In the event of divorce, if you're divorced, you may be entitled to spousal benefits. If you're at least 62, you were married for 10 years and you're unmarried now, and your ex-spouse is entitled, okay? You may be independently entitled without your ex-spouse being entitled if your ex-spouse is 62, your divorce has been final 2 years, and your own worker benefits would be less than 50% of your ex-spouse. The Bipartisan Budget Act of 2015 didn't change this dramatically. A divorcee is independently entitled, then voluntary suspension rules don't apply. So I'll tell a quick story. I did a seminar 2 years ago. A woman walked up to me at the end and she said, "Hey, we were married 10 years. I'm 62. Can I get the spousal benefit?" And I said, "Sounds pretty good." And she said, "Well, let me get my husband over here." And I said, "Well, no, if you're married again, it doesn't apply." Okay. Survivor benefits. If you're a widow or widower, you're eligible to collect either your own benefits or 100% of your deceased spouse's benefits, whichever is greater. 60 years old, reduced benefit. We talked about that. You must have been married for 9 months or 10 years if divorced, and you're unmarried after 60. Not much change in survivor benefits due to 2015 law, but I think you see here that claiming early has ripple effects. It's not just affecting the person who makes the claim, as we showed, of 25, 27% less than at FRA. It can affect for many, many years down the line. Okay, so let's talk a little bit about survivor benefits and how it can really affect for a long time. So in 2010, according to the census, there were 53,364 American centenarians living. Interesting enough, about 80-20, women live longer, 5 to 10 years on average, and actuarially, okay? Actuarial science is the law of large numbers. So women tend to outlive men. Life expectancy for 65 is there. But what about one spouse living to 97 is a 25% chance. Isn't that interesting? By the way, the number up here for 2020, instead of 53,364, it's about 90,000. It's almost doubled in 10 years. Centenarians are the largest growing decile group in the country. So we're living longer. So be ready for longevity. How long will you live? That is the question, right? But age 92, a 50% chance, mentioned 25, and there's a 10% chance that everyone on this call will see centenarian status. So pretty interesting to be aware. And let's talk about a couple of risks here. We've talked about tax risk. What about the longevity risk? Okay. Well, everybody wants to live long and prosper, right? But longevity is actually a risk multiplier. The longer you live, the more chance you have of being exposed to taxes, inflation, market risk. Okay. So longevity is something we need to plan for. Lifetime income is something we need to plan for. So let's be aware of that as we plan. So I'm going to give you a quick case study on file and restrict. And this is Joe and Cindy. You can see their numbers here. So what happens if both file at 66, then they get combined benefits to 90 of 1.39 million. But what they can do in their status, she can file for her benefit at 66. He files a restricted for half of her benefit at 66. Then he gets his full benefit at 70. Cindy automatically gets the spousal excess. That's a pretty big difference. There's that 200,000 or so right there difference just from a file and restrict benefit case study. Okay, now your numbers may vary. Some people will not certainly be able to do this, but it is an interesting case study of how much difference proper filing makes. Now, here's an interesting one too. Do-over or reset strategy. Okay, so once in a lifetime, you get a chance to say, wait a minute, time out, I want to stop. So you have to pay back all the benefits received in the spouse if applicable, and it's a very straightforward form. So one more quick story. I was giving a seminar again a couple of years ago. Woman walks up to me at the end and she goes, wow, I think I need to do that do-over reset strategy. And I said, what's going on? 62, she filed. She worked for Duke Energy for a long time, and she had special skills. And she got a job down with Florida Power and Light, where she was going to make like $30,000 a month on a consulting contract. She didn't need her Social Security, and she also realized that working, because we had gone through that in a seminar, she was going to have to be doxed some of it. And she said, I really think I should stop. So she was very concerned about it. So that was where we could actually get the physical form, fill it out, and she sent it in by courier. And she had to pay back 3 or 4 months that she'd received, but I think she came out a lot better. So what if you're sitting here tonight and you're saying, great, I've already been filing for more than a year? Well, there's one other thing that you can do. So the start, stop, and restart is voluntary suspension. You must reach the FRA or later. You can restart anytime. Your suspended benefits grow by 8% to the age 70, inflation adjusted. And if they're not restarted until the monthly payments will be that 32%. So there's no additional growth, as we know, beyond 70. So another strategy that might apply to some people. So again, when we talk in the strategy session, we'll look at these options for you and see if they make sense. So it's a puzzle. Will I outlive my money? 44% of baby boomers and Gen Xers are projected to lack adequate income for their basic retirement and healthcare expenses. Determining a strategy begins with asking, how much do I need now? How much will I need in retirement? And how do I close the gap? It really comes down to that. It's a simple problem. The solution may not be that simple. Now, when you get your workbook, you're going to get a budget worksheet. So determining your current income needs should be fairly straightforward. You may already have a budget. You may not need to fill this out. You can say this is what we're spending. Now it says most retirees require 80 to 100% of their pre-retirement income. And I can buy that, because you're not saving for retirement. Your kids are probably out of school. You may have your mortgage paid off, et cetera, et cetera. So I think it's a logical argument to say that there would be some drop, but I'll also tell you, every day is Saturday. I live with a bunch of retirees. I want to buy that boat. I want to take that trip to Europe. What about Disneyland? Let's take the grandkids. Oh, the grandkids need these shoes. What about schooling for Susie? Mom can't afford it. All of these things come up when you're retired. So I like to think in terms of wants, not needs. So when you retire, do you want to live on 60% of what you were making before? Or do you want to live on 100? Or How about 120? What do you want to live on? Okay. So remember, social only provides about 40% of your workers' needed income, and you have to make up the gap with other sources. So when you do your budget worksheet, that is homework for you to bring to the strategy session, and we'll use that data as we plan. Okay, so we're going to use the data from the budget worksheet and work for your future plan. Now, how do you fill the gap? Okay, what other source of retirement income do you have? Well, you first, I'm going to stop here because I do want to show you this. Give me a second. And talk about other sources here. Sorry, I need to share the screen again. Sorry about that. Share the screen. Well, income from retirement accounts is what most people use. What are the pros? You can get matching funds. You maintain some or all control. Tax deductible when contributions are made, but what's the problem? Delays the tax and the tax calculation, except for Roths. You take the risk of investment decisions and income distributions. Defined benefit pension plans, I mentioned that those things are going away. Government employees have them with some restrictions. Some of them are not what they used to be. Fully funded, really simple, benefits a known amount. There's only one plan, no say in the investment, fully taxable, and affects your Social Security taxation. So defined benefit pension plans are great, but they're a two-edged sword. What about other investments? Well, this isn't a taxable bucket. You maintain control, that's fine. You might get some long-term capital gains, although generally speaking, that's not as good a benefit as many people think because they're trading those accounts, manage money. Taxes are paid on the earnings. You still have to pay taxes. Most people pay from a 1099 each year from lifestyle money. Reinvestment risk, market risk, no guarantee of principal protection, growth, or income. You take the risk of investment decisions and income distributions. Now, I want to talk just real briefly about a couple of other tools, and I'm not here pitching tools because our mission is education, but annuities can be a viable tool for many people. There are a number of different kinds of annuities, and we're not going to drill into the details tonight, but there are a number of different kinds. An annuity is simply an agreement where money is deposited and paid back. Now, let me give you three different types, which is not here. There's three different major types of annuity. The first one is government, public. What's that? Well, it's Social Security. It's the topic tonight. Social Security is an annuity. It's an inflation-adjusted annuity. And as Wade Pfau, one of the great researchers in the business today, says, it's the best annuity money can't buy because it's inflation-adjusted before you even get it. One. Two, private annuities. What's that? Defined benefit pension plans. We just talked about them. That's an annuity. You deposit money, you get paid for life. The third type is asset backed. Backed by an insurance company, you deposit money, you get paid for life. Here's the different types. What are the pros? You get control over your account. A lot of people say it's locked up. Today, annuities allow, generally speaking, a 10% free withdrawal from the very beginning. They have a death benefit. They're not nearly as restricted as your grandmother's annuity. If non-qualified, they're tax deferred. There's no mandatory distributions, guaranteed principal growth and income for life, but they're long-term. And one of the problems we have in this country is we live in a microwave society where we want it now. So they are longer term. Permanent life insurance, a lot of people haven't considered this for a retirement plan. There are a number of different types. And again, we're not going to drill into that tonight. You control the account. You have liquidity use and control of your money. You can take income tax-free loans and withdrawals up to the cost basis. There's no penalty for early access. There's no required minimum distributions when you get to be 72. And if you don't use it all when you're alive, you leave a leveraged death benefit. Again, what's the negative? It takes time to get a plan up and running. And I see we have a question. Okay, if you can't see my screen, somebody said they can't see it. I think we lost it for a minute, but we should be good now because I wanted to make sure I covered this and it went away. So that's essentially the summation of the Social Security benefit claiming options webinar tonight. The main thing is to plan now, to begin now. Now, remember that this is a two-part series. So we have this 1 hour tonight. Thank you for your attention and staying with me. It's been really good that most people have stayed on. I know webinars can be challenging. I did my best to give you a lot of information quick. You will get the workbook within 24 hours, which is filled out, and you can add that to your notes. I'm going to ask you for the strategy sessions. We're going to pre-book those, and you'll get a link to that. We can do them on Zoom, or we can do them face-to-face at the office in Seneca. I'll give you the address. It's your choice. In that session, we will do a number of reports, your Social Security analysis, your specific numbers that you can take away and put in your file. Number 2 is asset allocation. How do you allocate your assets for maximum performance and spend down, depending on when you draw that social from that first report? And 3rd, puts it together, retirement ready or not. How much do I need to make on my money? How much money do I need to save? How much can I live on? How long do I need to work in order for my money to last to life expectancy? So I look forward to meeting you on the Zoom one-on-one or one-on-two for a couple. I look forward to your questions. If I can't answer your questions in the strategy session, I will certainly find someone who can do it. And I want to thank everyone again for your attendance and for your good interest in this topic. It's a hugely important topic, and I look forward to talking to you further as we move toward retirement. Thank you, everyone, and good evening.